What if I told you the biggest money moves in the world don't happen on the news? They happen before the news breaks. While most retail investors are waiting for headlines, someone else is already positioning. Retail investors chase the news. Insiders exit quietly. I'm not talking about illegal insider trading. I'm talking about patterns, signals, and timing that smart money has mastered for decades. By the time the media tells you to buy, someone else is already cashing out. Today, I'm exposing the financial patterns smart money uses to cash out big, legally. If you've ever wondered why the market always seems one step ahead of you, this video could change how you invest forever. Watch till the end. Before we go any further, let's clear something up. When people hear the word insider, they immediately think of illegal trading. That's not what this video is about. Insider secrets are not about breaking the law. They are not about stolen information, hacks, or secret phone calls. They're about something much simpler and completely legal. Information advantage. Smart money doesn't win because they know more secrets. They win because they understand signals, timing, and human behavior. They know how to read what the market is doing, not what the market is saying. Every move we'll talk about in this video comes from public data, legal disclosures, and observable patterns. The difference is this: most people don't know where to look or when it actually matters. So when I say insider secrets, what I really mean is this: understanding the behavior of money before it shows up in headlines. And once you see these patterns, you'll realize the market isn't random at all. So who exactly is this smart money everyone talks about? It's not a secret society. It's not a single group. Smart money is a category of participants with size, access, and patience. First, institutional investors. These are pension funds, insurance companies, and large financial institutions managing billions of dollars. They can't rush in or out of the market. Their moves are planned and spread over time. Next, hedge funds and asset managers. They don't rely on headlines. They rely on models, data, and probability. When they move early. And when they exit, they do it quietly. Then you have company executives, CEOs, CFOs, and insiders who legally disclose when they buy or sell their own company's stock. They know their business better than anyone. And when multiple executives sell at the same time, the market listens, even if the news doesn't. There are also politicians and connected elites, not because they're special, but because their trades are often reported publicly. Again, nothing illegal. Just information hiding in plain sight. Here's the part most people miss. Smart money doesn't predict the market. They position themselves ahead of it. They don't guess what will happen. They prepare for multiple outcomes and profit when the odds shift in their favor. This is the first real secret smart money understands. Price is the effect. Money flow is the cause. Most people stare at price charts, waiting for confirmation. Smart money watches where the capital moves first. Before price ever explodes up or collapses down, volume starts telling a different story. Large investors can't hide their footprints. Their size forces them to leave clues. When you see unusual volume, not hype, not headlines, but real volume, it usually means positioning is happening. And here's the key: volume comes before price. Smart money also rotates between sectors. When tech gets crowded, capital quietly moves to energy. When growth overheats, money flows into defense. The market doesn't move randomly, it rotates. One of the easiest ways to spot this is through ETFs. ETF inflows and outflows show where large capital is actually going, not what people are talking about online. Here's what you can do starting today. Watch for unusual volume spikes, especially when price is still calm. And track ETF inflows and outflows to see which sectors smart money is favoring. When you stop chasing noise and start following money, the market starts making sense. Now this is where things get really interesting, because insiders don't need to guess when to exit. Company executives, CEOs, CFOs, board members are required by law to disclose their trades. These disclosures are public. They're called Form 4 filings. When an executive sells stock, it doesn't automatically mean something bad. Executives sell for many reasons: taxes, diversification, personal planning. But context is everything. Here's the pattern smart money watches closely. When insiders sell together, it's rarely a coincidence. Many insider sales are pre-planned. That means the exit strategy was decided long before the public ever knew what was coming. They're not reacting to headlines. They're executing a plan. Historically, before major market corrections, insiders tend to reduce exposure quietly. Not all at once, not dramatically. Slowly, consistently, and legally. While retail investors are celebrating new highs, smart money is already locking in profits. This doesn't mean you panic every time an insider sells. It means you pay attention when selling becomes clustered and well-timed. Because when insiders cash out at the top, they usually leave the noise to everyone else. Here's a hard truth most people don't want to hear. The financial news isn't designed to make you rich. News doesn't predict market moves. It reacts to them. By the time a story reaches your screen, positioning has already happened. Large investors move first. They build positions quietly, over weeks or months. Only after that movement becomes visible does it turn into a headline. This is where retail investors step in, at the worst possible time, because headlines often become exit liquidity. When excitement peaks, someone needs buyers on the other side of the trade. So while retail investors are buying the story, smart money is selling into strength. This isn't manipulation. It's structure. Markets reward early positioning, not late reaction. That's why the same pattern repeats over and over. By the time the news reaches you, someone else has already cashed out. If you rely on headlines to tell you what to do, you'll always be one step behind. If smart money moved all at once, everyone would see it. So they don't. Big investors use layered buying and selling. Instead of placing one massive order, they break it into hundreds, sometimes thousands of smaller ones. Not to manipulate the market, but to avoid moving price too early. This is why markets often move sideways for long periods. While price looks boring, positioning is happening underneath. You may have heard the term dark pools. At a high level, these are private venues where large trades can be executed without immediately affecting the public price. They're legal, they're regulated, and they exist for one reason: to handle size. This leads to something most people completely miss: the distribution phase. Smart money doesn't exit in a single moment. They sell slowly, carefully, often while the market still feels bullish. That's why tops take time to form. By the time the drop finally happens, the exit is already complete. If you only watch price, you'll miss the entire story. Now here's the part that really matters. You don't need to be rich to use these strategies. You don't need special access, and you don't need insider connections. What you need is a shift in mindset. First, think in cycles, not hype. Markets move in phases: accumulation, expansion, distribution, and correction. If you only show up during hype, you're already late. Second, focus on timing, not prediction. Smart money doesn't try to guess the future. They wait for confirmation and act when the odds align. Being early isn't the goal. Being prepared is. Third, protect your capital before chasing profit. Big money survives because they manage risk first. Profits come after protection. If you can't stay in the game, you can't win the game. You don't need millions. You need discipline and awareness. Once you stop reacting emotionally, once you start watching behavior instead of headlines, you stop playing defense and start thinking like smart money. Before we wrap up, let's talk about the traps that keep most people broke and why it's not the market's fault. Trap number one: FOMO buying. You see a stock skyrocketing, everyone's talking about it, and you jump in without a plan. Chasing hype is a fast track to losses. Trap number two: holding through distribution. Big money exits slowly, quietly, while retail holds on, hoping the top will last forever. By the time the price drops, it's already too late. Trap number three: emotional investing. Fear, greed, panic. These are your worst enemies. Smart money doesn't let feelings dictate moves. Neither should you. Trap number 4, believing social media gurus. Just because someone posts fancy charts or a hot tip doesn't mean they understand positioning or risk. Here's the truth you need to hear. The market doesn't steal your money. Your emotions hand it over. Master your mind. Follow the patterns, and you'll avoid the mistakes that destroy most retail investors. Here's the final truth. Insider financial secrets aren't magic. They're patterns, patience, and positioning. Once you learn how money exits, you'll never enter a trade the same way again. If this video opened your eyes, like it. Subscribe for financial truths they don't teach in school. And comment below. Do you think the market is fair? Remember, the market doesn't have to control you. You just have to understand it.